hello, everyone. Just as I get started, I wanted to thank my panelists, but also just as a transition from the last speaker you heard, I'm not sure how many of you in the room are familiar with Bloomberg's ESG products. So wanted to give a quick overview and then talk a little bit about one of our newest products. So if I don't have the clicker, so I'm going to hope that someone's going to click this for me. So anyone not familiar with Bloomberg products, as you know, we're a data company, and we have ESG data on 11,500 publicly listed equities, publicly listed companies, and we also have third-party scores available on the terminal. In addition to our ESG data, this data is fully integrated into our ESG workflow. And in addition to the data, what we have is comprehensive indices. So a lot of you may have heard about the importance of materiality and sector-specific metrics. Bloomberg most recently launched our Bloomberg SASB ESG index family. And this is a big introduction for us because I think it's the first time we're creating equity indices. We've entered the equity space, as well as these indices are available for our fixed income family as well. And lastly, we continue to supplement all of this with expert news and research from Bloomberg NEF, Bloomberg Intelligence, and our large news media organization. So when you look at all this data, one of the things you just heard was what's going on with AI, natural language processing. What we've done is we've taken the volume of news that comes through our terminal, and you can now identify what the news sentiment about companies is. So we've tagged used natural language processing to say what is the daily sentiment score of any company that has English-based news available. So if you're interested, happy to chat with you after the meeting, but I just wanted to wrap it up and say there is a lot that combines, and this is Exxon on the terminal. I don't want to get too deep into whatever caused a big news splash on July 31st, but I look forward to talking to many more of you about this new product. So with that, I'll jump into our panel and maybe start with introductions with Steve and Steve, and then we'll come to Kathryn.
Good afternoon. My name is Steve Feeney. I'm the Managing Director of Capital Markets at OPIC, the Overseas Private Investment Corporation. We are a U.S. government agency, the U.S. government's development finance institution. We support project finance transactions globally in the emerging markets.
I'm Steve Liberatore. I am a Nuveen employee and happy to be one. I am our lead PM for all of our ESG and impact funds on the public side.
I'm Kathryn McDonald. I'm the head of sustainable investing for Rosenberg Equities. We are wholly owned by AXA Investment Managers, which itself is owned by AXA. So we're sort of third in the chain of a company that is deeply committed to sustainable investing, ESG, and impact.
So with that, the title of our panel is about technology for climate change and technology and tools to address climate change-related integration. So Kathryn, your firm just published a paper on climate reduction, and it said, moving from carbon footprint to carbon footpath. Can you talk a little bit about the current pace of change, your analysis, and especially as it relates to environmental scores and a shift that you're seeing towards greener technologies?
Sure. So the starting point for us was really this idea that we see many of the largest institutional investors thinking carefully about emissions exposures in their portfolios. And again, I only work in listed equity portfolios, but thinking about this way of decarbonizing their portfolios by simply minimizing or cutting back on the number of polluters that they hold. And this has been the practice for a number of years, and in our own funds. We also work to really pretty drastically reduce point-in-time Scope 1 and Scope 2 emissions. We have evolved our thinking on this, though, and now we are really of the mind that instead of simply rejecting all large polluters, just on the face of it, we really need to dig deeply into which of those companies are actually positioning themselves to participate in a green evolution. We can point to some large polluters today that have, just really stridently dug their heels in and said, nope, we're not changing anything about the way that we operate our business or the way that we run our plant. But we can point to other large polluters that are on this very positive carbon foot path. And so what we do in the paper that you referred to is really think more critically about what is other types of information that we can use in addition to point in time, scope 1 and 2 emissions, that will allow us to make that evaluation and hopefully be able to stay invested in certain sectors like utilities and energy, but also be on the right side of history as investors. We think that these companies are doing something to really save themselves. We want to be on the right side with them.
So I'll come back to it, and just Steve, both of you actually, your role is to bring greener technologies to the market, and you fund many of these technologies. Can you talk about what's really out there, and how do you find these investment opportunities?
Well, as the U.S. government agency, we have numerous avenues of approach from various conferences around the country, around the globe. Most importantly, we have to partner with American companies in anything that we do, so that if General Electric, for example, is doing a series of wind-fired or wind power plants or solar power plants, they will bring the deals to us to support their efforts in moving globally into environments where it's important for us as the development finance agency of the U.S. government to participate. So we have found, since the Green Bond Principles of 2014, that the market is evolving. Unfortunately, a lot of our deals have been floating rate, and the market is first evolving from a fixed rate perspective, as I'm sure Steve will enumerate. But we've been able to do about $1.6 billion since September 2014, supporting 17 global projects and about 75 loan disbursements by OPIC.
For us, we have a long history of investing in impact securities in the public market. We actually have a framework that we created back in 2007 with my team and our responsible investment team worked together to create this impact framework that obviously green bonds would fall into. And we've evolved that over time as the market has changed. And we're fortunate because we have a long history in this space. And I think that we have developed a reputation as being innovative, unique, willing to look at new and different types of transactions. So we have been primarily involved in every first type of security or inaugural issue within the public market, whether it's the first index eligible green bond, the first securitized auto ABS hybrid deal, the first blue bond, the first CMBS LEED certified deal, first forest bond. And for us, it comes from a working partnership with issuers such as OPIC and with underwriters, and having a reputation as being willing to have the skill and ability. In our team, we have 50 analysts that have about 11 years of experience. We have 12 traders that also have about 11 years of experience. So we've been able to build a very broad exposure and expertise in impact securities in the public space. So we're able to look at a wide variety of types of securities. And I think that's really put us in a position to kind of be at the forefront. And Bloomberg has listed us as the third largest holder of labeled green bonds. And we think the actual unlabeled market is actually about 3 times as large as the labeled market. So we look for securities that have a direct and measurable outcome associated with them, not only in environmental outcomes, but also societal outcomes. So for us, it's really a working partnership to try to lever our expertise to deliver those types of securities to our investors, first and foremost, is making sure that they generate excess return and outperform over time.
I'm going to come back to a point Steve made. 1.6 billion since 2014, and that's been the focus. That's a large number, but we need a lot to move the needle towards green investments. How do you find these investments? Is there enough volume of deals out there? And how do you kind of go about seeking it, especially on the green side, I think, and we can talk about both.
No, I think the key is it has to be a broader view. One of the interesting things that I have found is that historically, impact investing had been related primarily to the private markets and maybe to private equity and venture capital. So now that we're getting into an understanding that impact can happen in any market, and public fixed is an area that's very nascent. So we're starting to see a wider variety of opportunities where we're no longer just need a super sovereign issue to come with a green bond. You know, we can work with, you know, emerging market companies to create, you know, geothermal facilities. We can work with structured securities issuers to fund solar loans and leases, or secured properties that have LEED or BREEAM certification. Or we can work with agency securities, agency issuers to find projects that we definitely want to be involved in and support. So the fixed income market, I think, in the public space provides a very wide variety of opportunity. So while we have done about $250 billion in labeled green so far this year, you look outside of that space for the unlabeled, you're probably looking at more like a $400 to $500 million type of issuance trajectory. We finally have gotten to having more than $1 trillion of labeled green outstanding. As more people get comfortable with these types of securities, I think you'll see more issuance kind of come up to meet that demand.
I think one development that we've witnessed is the segmentation of the marketplace. You've got green bonds, you've got impact investing. We just offered $100 million today on a floating rate basis for 2x gender specific use of proceeds. So that a bank in Ecuador is taking $100 million from OPIC and is going to deploy it into supporting women entrepreneurs and women-owned businesses in the country of Ecuador. So that's sort of a first for us, labeling a 2x gender-specific issue. And we're looking forward to others, you know, following in that void.
And I want to come back to which sectors do you think are really underexplored, though? So gender is new for you, but if we think about climate change, are there certain sectors where we are still not having the dialogue? And this could apply both to the equity side as well as the fixed income side, because everyone talks about utilities, everyone talks about a few large deals and Apple issuing green bonds, but where are we really not having a conversation yet?
I think that we, you know, certainly within listed equities, we could have more of a conversation on that, you know, sort of second tier level of polluters, you know, cement manufacturers, iron and ore, you know, we've got utilities, which is the massive headline, and energy, and, you know, industrials below that. So there are parts of the economy, certainly agriculture and farming, that contribute not as much as those headline numbers from utilities, but are definitely need to be part of the conversation on climate, need to be part of the conversation on how we need to, you know, collectively rejigger the economy in a way such that we can move toward a green transition.
I think in the fixed space, the one area that I think is very interesting and holds a lot of promise for being able to make the concept of climate change or combating climate change more tangible to an individual is really in the structured security space and funding solar loans and leases, for example. You know, one of the reasons that we have found home ownership to be affordable, being able to afford credit cards and auto loans and things like that is because we have a fully functioning ABS market where we're able to distribute risk to investors who are looking for certain types of risk exposure. When we look at solar loan and lease deals right now, the weighted average FICO of these transactions is about 750. So these are the prime of the prime. So these are people who are able to get financing regardless. So the real goal, I think, is if we're able to get the ABS market to fully function in solar loans and leases, and we're able to bring down that weighted average FICO to, say, 650, so that the average individual could maybe have an affordability opportunity with solar, then you start looking, you combine that with the reduction in cost of solar arrays, it becomes a viable financial opportunity for an individual. They can put solar panels on their home, and they themselves can see, oh, wait a minute, combating climate change is actually a positive to me because I can save money doing this while being beneficial to the environment. And it's no longer this, I'm driving on the interstate and I drive by an Apple solar farm and say, oh, wow, that's cool, there's a solar farm. It becomes more individually tangible, and people, I think, can become more focused on climate change as a concept and how they can benefit from addressing those issues.
Kathryn, just given your quantitative approach to, your firm's quantitative approach to finding investments, can you discuss how you've leveraged new technology, new data to identify investment opportunities or highlight who's lagging versus a leader on climate change issues?
Sure. I think I'd like to start, though, with old technology. So we start at the place where we do with all financial information. As active managers, we're a quant equity manager. As active managers, we need to take in as much data as we can from as many companies as possible. This is the thesis for quant equity investing. And we need to make sure that we can compare that data across different securities effectively. So that idea of comparability, the trustworthiness in the data. We need to even make sure that that two data points are actually talking about the same company. So what we have found when working with ESG information, it's very, very tricky. It's getting better, but the data that's out there is, from some providers, pretty excellent and reliable at this point. For other providers, even questions of basic, what we would think of as data hygiene are completely missing. Corporate actions that aren't caught, identifiers that aren't updated. We asked one vendor recently about time stamping, and they just kind of looked at us like we were crazy. So it's that basic hygiene that I think is very important with ESG. Then the next step is to say, we're going to do research on ESG and impact themes that try and relate this new data to fundamental drivers of risk and return. How are these ESG concepts related to earnings growth, earnings surprise, valuation? Work that we did last year on diversity shows this ability to create a profitability moat that more diverse companies have compared to their peers. So this is all, taking what we have learned for decades doing active management and simply using ESG as yet another lens through which we can view the competitive capability of companies. For the new stuff, there are these new data sets, much like the one that you just heard about, which are news flow related, sentiment related, AI and NLP based. We also have a lot of new physical risk information that's coming to us. We have a bunch of these sort of scenario 2-degree alignment path testing data that we have access to. But I will say all of it is fascinating, and we are cautiously optimistic about much of it, but I think that we should, as a group, be wary of these data sets, even as a quant, I will say that, because they are completely unproven in investment circles. But if we always stick to this commitment to saying, I want to build the most robust picture of a company with respect to its threats and opportunities, then we can bring in these new data sets and let them influence us either a lot or a little as we go.
I saw you nodding and would love to hear, given how long you've been at this.
Thank you for nicely calling me old.
No. I meant it as how long your firm has been doing it. That was the point.
I think that what people that aren't familiar with ESG investing really do is they sometimes confuse what we're saying. That we're not making a value judgment that you shouldn't invest in oil and gas companies, for example. What we're saying is we're using ESG data as another lens to evaluate the creditworthiness on the fixed income side of an issuer. That if you look at an oil and gas issuer, you don't want to invest in one that's continually being fined for having spills or poor regulatory results, because ultimately what that firm is doing is putting at risk their ability to generate free cash flow, which over time as an unsecured borrower is your source of repayment and valuation adjuster. So what you want is to be able to find those issuers that are doing things the right way for their industry so that you can gauge the stability of their free cash flow in the future. And I think that's a nuance that not everyone quite gets fully yet.
Given the challenges with consistency and comparability of the data, can you talk a little bit about how you've dealt with it, given kind of the fundamental research or a quant research approach that you've used? Because the challenge is, how do you find the most common data point for the full peer group and actually do a robust analysis?
Yeah. So let me start by briefly saying that we completely reject this idea of score. So you go to these different ESG data vendors, everybody has a different, sort of headline score for companies, and then, the example that is always trotted out is Tesla. You have vendor A saying Tesla is this great ESG company, vendor B says they're kind of middling. So what we're really interested in is the data that underlies those scores. So what we get from our vendors is all of that underlying data, and then we have our own proprietary, way of making, making that into a score or using it for other purposes. So I think the rejection of score and the focus on this idea of what do we regard as material for any given sector, and we're going to kind of build it ourselves, that's something that has given us a lot of confidence.
As a U.S. government agency, we run a very narrow path between what we're able to divulge about our transaction and the business confidentiality with our client that has brought us the deal and is going to be the obligor. So that over the years, we've got a tremendous populated Office of Investment Policy that not only ticks the boxes for our support, but once we have funded a transaction, we actually send people out into the field and they kick the tires to make sure that what was represented in the formative stages is actually being implemented for the benefit of our investors. Because if Steve doesn't buy what I'm offering to sell, then we haven't passed the smell test.
Right.
And I would say, though, from working with you over time, the issuers are more than, almost in all cases, more than happy to share the data that we're asking for, because in a lot of cases they want to be able to show, hey, we're doing this type of transaction, so we expect that you may ask for this, or we want to be able to talk about what positives on the environmental side we're bringing to the table for producing or funding this particular project. So
and they may have local filings that they have to adhere to. That
I think it's just a matter of knowing what to ask for.
And what's the difference you see between emerging markets, small cap, large cap, US-based firms or European firms? Any patterns you've identified through your process?
For equities, there is a real paucity of data in emerging small cap. That's still the area that I think is yet to be developed or yet to be mined, depending on the way you view it. But we can, and this is where we can start to use these other newer types of data to try, or newer types of investigation like NLP and machine learned information, to try and get at some of that missing information. But we know that the data vendors are themselves, pretty aggressively going into emerging small cap and trying to kind of ferret out the same information that we have for developed large cap, for example.
On the fixed side, what's been interesting to me is we've had a lot in structuring green bonds would be the easiest example. We've had great results and responses in working with emerging market issuers. They've been very responsive to any request for data or information. And where we've oddly had some trouble has been with US-based Fortune 500 companies. They have been more reticent to provide the information we asked for. Not all of them, but just some of them. So that's been a little bit of a unique dynamic that I think that we've seen develop in the market, and I think that will change over time, but that's just been something that surprised me a little bit as the market has evolved.
That might be one of the first few times I've heard, but it's individual requests. It's survey data. It's not what's available publicly.
Right.
Got it. I know we're just up on our time, so we'll look for what's audience questions, and I still have a few more if we can squeeze them in.
Great. Let's take a couple from the audience. Steve, Liberatore, I'm going to toss this first one to you. What's the difference between green, social, and sustainable bonds? Can you break those down for us?
Sure. It depends upon what the particular, for us at least, it would depend upon what the particular transaction is funding. So for us, as I mentioned, we have a proprietary impact framework, and we focus on 4 thematic areas, 2 of which are societal, so affordable housing and community and economic development. 2 are environmental, which would be renewable energy and climate change and natural resources. And the definition can just evolve depending upon what the proceeds are being utilized for a particular transaction.
Great. Next one. What kind of support is reasonable to request from federal regulators and government agencies as it regards ESG investing? For anyone.
Reasonable or desirable? Or I think that we should require lawmakers, regulators to actively address these ideas. I think that it kind of, depending on where you're standing on the planet, the regulator takes a bit of a different view as to whether or not this is part of one's fiduciary duty, or how tightly guarded the definition of ESG should be. We see that happening in Europe now, these sort of purposeful definitions. But I think that we are asking corporations to do a lot, and they should do a lot, but they cannot do it without the reinforcement of government on one hand and the citizens on the other hand.
We have, as a U.S. government agency, have the Office of Investment Policy, as I mentioned, and they craft their checklists with the World Bank, IMF, a whole bunch across the spectrum of DFIs as far as what environment, we don't adhere to anything from the EPA, but it does get embraced in our Office of Investment Policy and across the industry.
Let's do one more, and then I'll let you
All
have
right.
the final question, Amisha. Back to Kathryn. Talk to us about the difference between industry-wide standardization and what should be proprietary information at your firm. So do you think that, if things are being analyzed proprietary in a vacuum, does that make it more difficult to analyze across companies, or should we have more of a generally accepted roadmap to improving scores?
So we are all for standardization. We are big proponents of SASB, for example, and there have been a couple of other standardized methodologies proposed. I would relate your question back to this idea of, in active management, all active managers have access to standardized financial statement information. That provides a groundwork for analysis, or a bed for analysis, that we can go confidently to that information because it's timely, it is standardized, it is audited typically. That can be the basis for what we do. But then as active managers, it's our job to go out and pursue more and different through all kind of creative endeavor to build upon that in our assessment of a company. So I don't see that there's any conflict between having a standardized, reliable place to start and an ability to build a whole proprietary system around what one believes and what one thinks will be rewarded.
If I have time for one last, I'm 30 seconds in, but if there was one last wish, are we moving fast enough? And if not, what's your one wish to drive investment towards sustainable solutions?
I'll go. I think one of the things to me that I find most interesting is when I talk to issuers, is that there's still a lot of misperception around what's required of them to issue, say, a green bond. And I think the biggest key is to get them to understand that what we're asking for is information they already have. And it's just a matter of getting them comfortable with sharing it with us, that we're not asking for you to hire 40 people to calculate some, very intricate type of data. You already have the information. Like I say to issuers that are coming to market with a green bond for a solar power project, if you don't know or can't tell me the gigawatt hours of power that's going to be produced next year off of this after you've run it for a year, then I shouldn't lend you my money because you're incompetent. So it's a matter of just getting them comfortable with sharing the information and getting them to understand that there's a benefit to them sharing it, because it allows for them to talk positively about what they're doing to combat climate change, and allows them to speak to their customers, their employees, their regulators, and their stakeholders about the good that they are doing.
Anything to add, Kathryn or Steve?
I'd like to shorten our own internal deal cycle time so that we can move things quicker through the pipeline and into the hands of the street.
And I'll say that I think we need to move more quickly, but we also need to have a conversation about the winners and losers of a green energy transition. So we are, if things go to plan, we are going to have a number of people and a number of positions that will be made redundant or unnecessary. We will also have a bunch of requirements for new skills and abilities that may not exist or may not be throughout a company's workforce. So I think in parallel to having the conversation about, yes, we need to do more, we need to do it quicker, we need to collectively take on the discussion about how this will impact human beings in the economy, both for better or worse, and make a plan for that.
With that, we're up on our time. Corporate education, get the government to move faster, and let's think about the social cost of moving fast enough. So thank you, everyone, and thank you very much for joining me today.